Hi everyone, welcome back to Level Up with Dawn. Today I wanted to do a video on the mistakes I've made through investing. I thought it would be helpful for me to make a video like this because I have done one based on property investing, and I feel like right now, especially when the market is where it is and people are definitely looking to invest, you should know what mistakes I made first before you go and invest yourself. So the first mistake that I made was following the crowd. And especially now, I think that's something that people could make if they're not careful. At the time, cryptocurrency was on everyone's mouths. Everyone was talking about it. Everyone was talking about buying Ripple, buying Bitcoin. There were IPOs or ICOs happening, and when I was at work, I'd hear people talking about it all the time, and I thought, I want to be a part of this. What's going on here? I am interested in investing, but this is not a branch of investing that I'm a part of. So I decided to buy cryptocurrency. And the thing is, I bought it at a time where I think a big crash had just happened. So I was thinking, oh yes, perfect. I'm gonna buy it low now because it's gonna rise in the future. Hint hint, Sasol, Capitec, who else do I need to mention? I'm gonna buy it now and it's gonna rise in the future, but we still at those levels, and it's okay. It's okay. I still have those investments. I haven't cashed them out, and I'm not going to cash them out because now I understand the fundamentals of the things that I was investing in. But when I bought those cryptocurrencies, I didn't understand what I was buying. I hadn't read any white papers. I just saw there's people getting rich from Bitcoin. Oh, Bitcoin's cheap now. I better buy so that when it goes back up, I'm rich. But it doesn't work that way, especially because it's not a share, it's a currency. It has a different vibe, it has a different momentum, it has a different behavior. And I hadn't taken the time to learn that behavior. I just saw all the upside, but I didn't know the fundamentals. So don't follow the crowd if you don't know where they're going, if you don't know how they're getting there, if you don't know why they're getting there. If you do know those things, then you're not technically following the crowd. You're making a decision based off of the information that you have, what you have researched, and now you are choosing to execute on that. But following the crowd is very dangerous, especially if you don't understand the rationale behind why people are following this thing that they are following. Right now, a lot of people are looking to buy shares. Please be careful. Make sure you understand what you are buying into, whatever it is. The second mistake that I made was withdrawing from my unit trust. I, at the time, wanted the money to pay off a loan, and I thought, oh, I may as well, the money is there, I may as well cash out some of it and use that money to pay off something else. I mean, it's going from one investment to another investment. It shouldn't really matter, but it does. Because when I invested in my unit trusts, I was doing that with the view that I'm going to be investing long term. But now, probably what, 2 years into it, I withdraw. It hasn't had time to appreciate in value for as long as I intended it to. Also, I could be losing out on gains. I could be losing out on market movements that could substantially benefit my portfolio in the future. So please be careful with that. Do not use your investments as savings. And I'm going to make that a mistake 2.1, because I had the mentality that any extra money that I have goes into investments. But the thing is, in my head, that was me saving. But that's not the same thing. I'll do a video on that explaining the difference between saving and investment, because they're completely two different things with completely two different goals. Don't use your investment account like it's a savings account. You do not need to be withdrawing from anything, from any of your investments unless they reach maturity, or unless you have really fulfilled your mandate of investing long term in that thing. And 2 years is not long term, not in shares, especially not in shares. I don't even think 5 years is long term. You need to be thinking decades, because that's when you really start seeing the value. Mistake number 3 is not starting my retirement annuity sooner. So about a year and a half ago, I opened up a retirement annuity. I set up a debit order to deduct money every month so that it's steadily growing without me having to be too active in it. And I wish I had done this sooner. I wish I had done this from the first month that I started working, because just seeing the benefits of it in this short amount of time makes me think, if I did this 3 years earlier, where would I be now? But that's why I'm talking to you guys about this. Do it now. Set it up now. If you are an employee, your pension is not enough. It will never be enough. Stop relying on your pension. I don't care how much extra you put into it, it is not enough. You need a retirement annuity. And on top of that, retirement annuities get tax benefits. Why? Because you are alleviating the burden from the government. You are saving for your retirement on top of your employer providing for your retirement. So then you won't require the state to look after you during retirement. Please, guys, get a retirement annuity. There are a lot of asset managers who do offer them. You will not regret it. That is one thing you will not regret. To have a lump sum surprise you on your 60th birthday, like, who doesn't want that? Mistake number 4 that I've made is investing in the stock market with money that you need elsewhere. If you see something in the market, if you see a share price, or if you see a company that is about to IPO and you want to be a part of it, no one understands more than me wanting to be a part of that, wanting to get a piece of that, wanting to benefit from that situation. But you have to do it with money that you do not need elsewhere. You cannot be maxing out your credit card to buy shares. You cannot be maxing out your overdraft to buy shares. You cannot be delaying paying your bills just so that you can take that money and invest it in the stock market. You have to be rational about this. Yes, this is an opportunity to make money, or it's an opportunity to grow your wealth, but you have to make sure that you're being responsible in that. You cannot be making investments off of the back of debt. The only investments that make sense off of the back of debt are those which generate you money continuously. Buying a rental property, starting a business. But shares don't work in that way. Yes, they may pay you dividends twice a year, but for the rest of the year, are you gonna keep selling that share to get the capital gains? It just doesn't work. Please spend disposable money on investing in shares. My final mistake is not having a tax-free savings account that invests in the market. I only got a tax-free savings account last year, and it's been so beneficial. Number one, because there's no tax. You do know your fixed deposit, the interest you earn on your fixed deposit, if you have a money market investment, those things get taxed. So to have something that doesn't get taxed is so beneficial, especially if you're keeping your renter's deposits in there, if you are saving for the short term for something that is really beneficial. There is a limit on how much you can save every year, or how much you can put in that account every year, but it's big enough for it to do its job. If you can save on tax legally, then you should, especially because it's encouraging the country to save. That's why these tax-free savings accounts exist, because we are not savers as South Africans, and I'm probably the textbook example of not being a saver. My money is counted for before it reaches my account, but that's not how you're supposed to be living your life. If you are not a saver, take this time now to open up a tax-free savings account. And you don't have to put a lot in it. You can put 100 Rand a month and just keep it there. And as you get more money, put more money in. But have a savings account. It's so important. You never know what could happen. You could be retrenched. An unexpected expense could come up. And then what are you going to do? You do not want to be going into debt to pay for things that are not going to make you money. Having a tax-free savings account that invests in the market is so beneficial because you're probably going to get a much higher return from that account rather than having an account that just gives you a straight interest rate. And I wish I knew this sooner, because I thought it was just going to be a normal savings account but tax-free. But no, you can actually make it an investment, a tax-free investment, which is amazing. And I think it's something that everyone should take advantage of. There are some asset managers who do have that product. Just do some research. Make sure you ask around. If you have a financial planner, ask them who they know that can give you that product. Make sure your tax-free savings account is invested in the market, because you are exposed to better returns, especially now when the repo rate is so low. Because one thing people forget is, even though, yes, the repo rate is low, and that is great for our loans, we're going to be paying less monthly, that means our savings accounts are also getting less interest. There has to be a balance. You can't keep high interest rates but then pay low on your loans. It all has to balance. It all has to level out. So we need to level up. Thank you for watching this video. Please subscribe down below and like. It really helps to support my channel, and I will see you next time. Bye.